that's not a good deal to get into. So you're buying the deal based on your pro forma, not the current standing of the deal. And that's never a good thing. People often do. You'd be surprised about how many sponsors actually do deals like this. So make sure that the deal that you are looking to invest in is cash flowing day one, right away. So there's no...
Welcome, everybody, to today's episode. With us, we got Ravi Gupta, COO and co-founder of Viking. Ravi, welcome.
Thanks, Nathan. It's always a pleasure.
Awesome. In this week's episode, we're going to be diving into the best practices for mitigating risk in real estate investment and also on the management side of things. So that's going to be covering due diligence, insurance, contingency planning, and we'll explore concrete strategies to avoid unnecessary exposure. So for investors, we'll examine how to evaluate sponsors, understand deal structures, and assess potential risks and returns before you actually commit your capital. And for operators, we'll review ways to maintain properties, finance projects responsibly, and build organizational resilience. Remember that managing risk isn't about avoiding the next crisis. It's about enabling stability and growth. So let's dive into it. From a risk standpoint, a lot of it, can do with the market and with a specific operator. But I want to dive into assumptions, generally speaking. So when we're looking at a property, what kind of assumptions are we making on the underwriting front that would help mitigate risks?
Yeah, so this topic is extremely important. I'll just step back and talk about risk in general. As a physician, I'm extremely risk averse. We tailor a lot of our content towards physicians, but many non-physicians invest with us. But most physicians are the same way, very risk averse, not only in their practice, because that's obviously naturally what has to happen, but also just in terms of life in general. And with that risk, sometimes there's a lot of analysis paralysis because of the fear for taking the next step. So I've kind of gone through this full life cycle of understanding risk, understanding when to move forward and when not to move forward. And, this topic is extremely important because it helps people decide whether they truly do want to invest in something or not. And, sometimes it feels uncomfortable to take that next step, and you may not feel completely assured of the consequences of taking that step. But if you're taking it in a intelligent way, and you have all of the knowledge and wherewithal to make that decision that you can have in that particular time, then that decision is an intelligent one. And then there comes the point where you get an asymmetric risk reward, right? You take a risk, but the reward is asymmetrical, meaning that it's much higher than the risk you take. And that's where we want to get you. And that's what we're trying to help you get in this podcast and, our series. So, all that being said, to answer your question, what do we look at when we underwrite a particular deal, when we consider the risk? And I really think the number one thing that we look at is geography. We don't invest willy-nilly in any location, because you can certainly imagine that in an area where there's job losses, there are people leaving the city. If you're investing in a Class A, amazing multifamily complex that has a phenomenally high cap rate, and you're like, this deal's gonna, just kick butt and everybody's leaving, obviously there's going to be a problem. Or if you invest in an area where there's a complete total influx of people, prices are sky high, they're able to charge a lot more because there's such high demand. You invest in a particular area like that, and then the market sort of dies down, and then you are left, hanging there. That's also not the situation that we want to get into. So you're really treading the middle ground there. You're trying to find an area which has a continuous amount of job growth, continued positive population migration. At the same time, there is, the prices aren't so high that you can't underwrite the property in 5 years in gaining some value at the end of that period. So that's in essence what the number one thing we're looking at.
Yep. And when you're making risk adjusted investments, a lot of that risk has to do with knowledge. So when we're conducting due diligence from an operator's perspective, when we're conducting due diligence on the market and on the property and on the operations and on the financials, what we're really doing is we're replacing the assumptions that we're making with knowledge of the submarket and of the deal itself. And so one way to help reduce risk is not only have the knowledge, but then to have contingency plans in place so that if worst case scenario does occur, you're not scrambling for a solution. You already have the solutions thought out. You have multiple exit strategies. For example, you have multiple ways to refinance the property or to run the property. So there's optionality there. And then that optionality is what helps reduce a lot of the risk. And from an investor's perspective, it's about examining and doing due diligence on the operator itself, on the submarket, on the comps, and on the overall kind of business plan of the deal. So with that, Ravi, how do we structure deals conservatively, again, to help manage risk with the knowledge that if you take out all of the risk from a deal, you probably aren't going to have the returns that investors are looking for?
Yes, yeah, that's a good point. And before I get to that, I just want to make one additional point. And for those of you who are just getting into it, or maybe don't have the time to finish listening to this, I want to give you something to take home right away. Our team, if you call them, if you make an appointment with them, our IR team will help you evaluate any property that you're looking at. So maybe if you're looking at a property that's not ones that we do, you're looking at some other type of investment that you may think makes sense and you're not sure, you're welcome to call us at any time and we can walk you through it. So all the things that we're discussing here, it takes some time and energy and expertise to actually be able to understand it fully. Anyone can do it themselves, but obviously if you have someone experienced, that helps. So we can help guide you there. Okay, so that being said, your question, Nathan, was
how do we structure a deal to be conservative? We're looking at fee structure, equity split structure, reserves to really kind of mitigate the risk or a potential downturn in the future.
Yeah, so there are the three immutable laws of real estate that oftentimes people think about. And one is to, number one, buy for cash flow. So when we're looking at a particular deal, if you're buying the deal and thinking that you're going to cash flow negatively, but because of the improvements you're going to make, you're going to at some point cash flow positively, that's not a good deal to get into. So you're buying the deal based on your pro forma, not the current standing of the deal. And that's never a good thing. People often do. You'd be surprised about how many sponsors actually do deals like this. So make sure that the deal that you are looking to invest in is cash flowing day one, right away. So there's no concern or question about that. The second is securing long-term low leverage debt. Now, this was a problem for a long time, actually, during this COVID craze, where people were, there's a period where people were just buying deal after deal and using bridge debt or bank loan financing, which had a shorter term. It was low leverage, but the term was short. And then, right now, for example, there are a lot of those debts that are becoming, those notes that are becoming due. People have to refinance. The interest rates are a lot higher, and it changes the dynamics of the deal completely. So make sure the debt is appropriate. And number three, have adequate cash reserves. You want to make sure that you are reserving enough so that if there is an issue, you have some money that you can tap into there. And some of you may have heard about a particular deal that we did years ago where we just raised the right amount to complete everything we needed to for that deal. But then invariably there was a bunch of things that came up and we just didn't have the cash on hand, and we had to hold distributions, and there became all these other issues that came from that. So make sure that you have enough cash and you underwrite for that reserve, and you make sure that even with that reserve, the deal still is hitting all your goals and your metrics. Then you have a strong deal.
I like your focus on cash flow, Rob, because cash flow is what gives you the optionality, right? When it comes to, meeting debt service or paying distributions or refinancing the property, it's that cash flow that really allows you to have that buffer. And for those that, the time value of money, they know that a dollar today is worth more, in value than a dollar a year from now, 3 years from now. So if you focus on cash flow rather than just relying on appreciation to drive the value of your deal, you're actually doing your investors a better service by providing cash flow consistently than solely banking on an appreciation or a sale in 3 to 5 years from now.
Yeah, cash flow is king. I mean, always just keep that in mind. If you're getting a lot of cash flow coming out of a property, that's a really good one to focus on.
Yep. So you want to be focusing from an investor's perspective on reasonable, rent growth assumptions, what fees are being taken out, what reserves are being, added on to the deal. And then also understand the range of returns that you could, potentially get from a deal, right? And ultimately, a pro forma is just that. It's a projection of future income and future expenses. And so what we do in all of our deals is we have multiple sensitivity analyses. And what that shows is dependent on, a variety of different factors or variables, what could the potential returns be? And it provides you a nice kind of spread of returns. So you're not solely reliant on, hey, it's just this one projection of this one IRR calculation or equity multiple. It actually provides you a full range of what potentially could occur over the entire hold period of a deal.
Yeah, so I just want to elaborate on that point because it's a super important one, Nathan. When you are looking at a deal, ask the sponsor for a sensitivity analysis. And just remember that term, sensitivity analysis, because many times what a sponsor does is they will say the deal is going to 2x your money in 5 years, or maybe 2.5x your money in 5 years. And then you're looking at the details, and the cap rate, in fact, either stays the same or in fact drops at sale. So they're projecting based on a more favorable market. And yeah, you're going to hit that 2x if the market is favorable. But what if the market is not favorable? Well, that's what a sensitivity analysis is. It lets you decide what the cap rate would be if you wanted to be conservative about your projections. So for example, if somebody said the going in cap rate was 5, it's going to be 4, the deal is going to exit at 4.5. You can say, well, no, I think it's going to go up. In fact, I think it's going to go to 5.5. So if it does, what kind of returns am I going to get? And you can look at that sensitivity table and really understand what the returns would be if you adjusted for that. And one last point to keep in mind, right now, and we're recording this in mid-September 2023, the cap rates are quite high. And we're actually getting deals that are hitting us that have cap rates of 5.56 that we are going to close on, which is phenomenal because it's a very low cost basis compared to the way deals were, just less than a year ago. So when you have a deal with that high of a cap rate, sometimes people will adjust it down a bit. And that's not uncommon. In fact, it may be just very evident to them and, to all the people that are projecting the outcomes that this deal that the market will drop in cap rates. It just naturally will happen as the interest rates drop of debt. But that being said, you can still use a sensitivity analysis and say, hey, look, I don't agree with that. I think that this cap rate is going to stay the same or even go up a little bit. And then you can look at that sensitivity table and make your own adjustments.
Yep. And one of the ways to help, again, mitigate risk and keep an eye on your returns is how often you're monitoring your distributions, the health of the property, et cetera, et cetera. So a lot of that comes down to the reporting, cadence of the operator. So Robbie, can you talk a little bit about the importance of strong reporting standards, what we do at Viking, and how they can help mitigate risk?
Yes. Yeah. So communication is so important. I'll give you an example. There's an operator that I invested with, and I invest in a lot of various other operators and sponsors because I'm interested to see what they do. And I do want to support them. Some of their friends, some of our colleagues. And one of them, I invested in a deal. It was a great deal. Everything went really well, but his communication was horrible. And I didn't hear anything from him. And the wire transfer for the distributions would come in every quarter, but it would be on different days. And, maybe it would be late a month. And I just didn't know what was going on with that property. And when I would talk to him, he would say, hey, everything's great. But I wasn't really sure because of his communication style. And I never invested with him after that, even though the deal went great. Another example is one of our mentors and advisors, whose name is Gary Rappaport, and he's shared this often, and I'm happy to share it here. He's had deals that went south where the investors lost all their money, but his communication is so on point, and he's always talking to investors, calls them consistently. I mean, his team, and he himself does this. So they trust, they know, they like him, and they consistently reinvest. And whenever he has an opportunity, it literally fills up in 24 hours. That's because even though he's done deals that went south, he still communicates effectively to his investors, and they appreciate that. So communication is super important. And what we at Viking do is every month we communicate exactly what's happening on the property, what kind of activities are going on the property, the NOI, the amount of units that are vacant, the amounts that are rented, where we are in our business plan. And we also send the entire financials over. So if you want to go in depth and detail on that particular property and look at the financials, you can do that. You can look at the financials and call us and say, hey, look, I'm just curious what is happening here. Can you explain this? And we're happy to do that as well. So we have this all built in, and whoever you are investing with should have a system in place where they have consistent, constant communication, and you can ask these questions that are pertinent to you.
Yep. And I always like to remember what I call the 2 W's, and that's why something happened and then what's next. So in reporting, why did, for example, a CapEx, a large improvement project not get done? And if it wasn't done, what are the repercussions and what's kind of the next steps for the business plan? I was talking with an investor recently and I said, hey, I had this one operator and they had a capital call and I don't really know what to expect. And my kind of first response was, well, hopefully this isn't the first time that you're hearing about the health of the property, right? Ultimately, if a capital call is held, most likely that property has been struggling for a few months and the operator should have communicated that to you. But then secondly, you have a capital call. The next real question is, okay, what's next? Obviously, a capital call isn't ideal. And for those who don't know, that's when operators call for a second round of capital to be ingested and kind of induced into the property. But ultimately, what's the next steps? Is there a reserve in place? Are they stopping distributions to complete a CapEx project that's going to drive value? What is kind of the reason for the capital call and what's going to be done with that capital? I think that also helps tremendously in reducing risk as well. So, Robbie, we've talked about, operators. We've talked about asset management. We've mentioned this on previous podcast episodes as well. But a large part of reducing risk is also diversifying across asset classes and markets and sponsors. Can you tell us a little bit about your kind of own investment strategy? Have you diversified your own portfolio in that regard?
Yeah, absolutely. So, just as you said, you want to diversify across various markets, because if you put all your eggs in one basket, there's a problem in that particular area, there could be complications. You want to consider diversifying across different sponsors, just so you get a sense of what other people do. And if there's one particular sponsor, after you do that you really know and you get to like them a lot, and you really trust them. Many of our investors just tell us that, hey, look, I don't care what other people are doing. We've invested with you. We trust you guys. We just want to invest with you only. That's absolutely fine. But what we're saying here is try, just look at other deals, look at other things out there. Maybe there's something that you might find that a reporting structure that you like, and maybe that's something that you want us to do for you. We're happy to do that kind of thing too. So just look at that. And then asset classes, right? So we particularly focus on multifamily, but if you are looking at different types of asset classes, we discuss this on other podcasts, office, retail, all that kind of stuff. It's good to spread your money out. So if there's a problem with one, then then the other ones will make up for it. So I think diversification is super important. The way I personally diversify, I really like multifamily. I've invested in other types of asset classes and things actually went south on those. And in my multifamily investments, I have done fairly well. So I continue to invest in multifamily. We're a multifamily syndication company. So I'm, obviously a little biased in that now. But I just believe in the asset class. I typically don't invest across the different grades of assets, like A, B, and C, and split my money equally there. C's are a little riskier, the rewards are a little better, but they're riskier. A is less risky, the rewards are less. I tend to go in the B and A area only. I don't want to take that much risk investing in the C property. And then I also like to invest in secondary and tertiary markets as well as primary markets. I like to create that diversification because what we're seeing now actually is that the cap rate increase in the primary markets is much more than the secondary and tertiary markets with the corrections that we're seeing now. For example, I kind of focus on Phoenix because that market was insanely hot for a while. Now it's like starting to dry up, but there are cap rates down in the 3%, and they are now up 200 basis points up to 5%. Whereas in some of the secondary tertiary markets, the cap rates were, still like that 4.5%, 5.5%, and now they're up maybe 5.5%. So, a 50 basis point spread versus a 200 basis point spread, that really makes a big difference. So those are some things to think about when you're considering diversification.
Yep, absolutely. Now I'll take it from more of an underwriting perspective because one of my roles at Viking is being the senior analyst and looking at a lot of underwriting. So I have my hands really deep in all the numbers. And so, as I said from the start of the episode, the whole point of underwriting and risk management is replacing speculative assumptions with existing fundamentals and data. So from an investor perspective, if you're looking at a deal, I would take a hard look at the assumptions that are in place in the underwriting, right? What are the rent growth assumptions? If there's a refinance, what are the loan to value and interest rate assumptions there? What's the exit value assumptions? Because all these assumptions should have a very specific why behind them, right? Even in regards as to the debt itself. Why was that specific debt placed on the property, right? And so when you have as many answers as you can, right? Obviously, underwriting is a very kind of fluid art where it's always going to be constantly adapting to the business plan. But those assumptions should have some sort of data related to them, and they should match the investment class and the risk profile of that specific investment. So, that's the pro forma, that's the underwriting, that's what we hope goes well, and that's what we're aiming to achieve with the business plan. But stuff invariably does not go to the business plan, right? I forget what that saying was, but there's a saying where it's like, if you have a plan, just know that it's just that. It's just a plan. Reality very rarely follows your exact plan, right? If you think about all the plans that you had in your life, how often do you look back and in hindsight, reality actually matched up step by step to your plan? Almost never. So invariably, there's going to be stuff that goes awry and that doesn't go to plan, or I guess to par with your pro forma. Robbie, can you talk to us a little bit about the contingency plans that you would need to have in case something does go wrong, kind of a what if bucket of capital available for deals, especially in today's environment?
Yeah, and you're absolutely right, Nathan. I mean, you try your best to plan things, and that's why you buy newer assets, because that there are less skeletons in the closet, so to speak. There are less maintenance issues. The deal's newer, so you're going to run into less problems. You buy from operators that you trust, that take care of all the deferred maintenance issues. Because again, you want to make sure that those things don't surface when you buy the property. But as Nathan mentioned, you have to have a contingency fund. And this is when I was talking earlier about the 3 immutable laws of real estate and having adequate cash reserves. Because if there is something that happens, if you throw enough cash at something, it goes away. That's like there's another saying, but just throw cash at something and go away. Now, we don't like to necessarily do that, but we do like to have enough reserves so that if there is something, for example, this happened to us before, a vandal came in and destroyed a bunch of mailboxes. We didn't underwrite that, and these are old mailboxes. It was a 1970s property. To get a whole new stack of mailboxes, it was something insane, like $2,500. And we had to pay money out for that, or like a retaining wall broke. We had to get that repaired. We didn't underwrite that. So when those things start happening and you have enough reserves, you're able to take care of it. Now, what if you don't have enough reserves? Well, then you're in trouble, right? You don't have that $2,500. You don't have that $10,000. You're gonna have to take it from somewhere. You take it from the cash that the property spitting out. But say that's even tight, then you're gonna have a deferred maintenance issue. And then when you have deferred maintenance, you don't have good mailboxes. The tenants are going to be like, well, I don't want to stay in this property. The prospective tenants are going to look at it and not even want to sign leases. You can get people moving out, and other tenants that don't care about those things moving in, maybe the less favorable tenants. Then you start getting in a whole bunch of other issues. And Nathan, we saw this, several operators we've seen where they will run a property to the ground, and that's their business plan. It's insane. It makes me cringe whenever they are awarded a deal, because I know what they'll do is, they'll squeeze every drop out of that and just destroy it. And then they're hoping for that organic appreciation. So they just sell it and, make a bunch of money off of it. And there's one particular sponsor that I'm thinking about, not going to name him, but you can probably look him up. Because there are not a whole lot of people that the bank is buying back some of their properties, but that's happening with this guy because he does exactly that, and that's where cash reserves come in. It prevents that from happening, so that you maintain that property. You don't have those bad tenants coming in. When those bad tenants coming in, they stop paying rent, they create issues, they break the law and this and that. It really puts a property down south, and it takes a long time to recover, sometimes years to get out of that hole. So you really want to prevent that from happening.
Yep. I'm gonna take a quick pause here, plug in my computer real quick. We'll cut this part out.
Yeah.
Okay. Cool. Ready?
Yeah.
Okay. Yeah, great point, Robbie. And you're seeing the same thing on the lending side of things, and the same thing with the insurance companies, where they're also building up a reserve, so to speak, right? I know in the past year we saw a lot less lending activity, and insurance have pretty much doubled or even tripled in some markets. And what they're doing the same thing for their business strategy, right? They're really kind of trying to mitigate risk and really build up reserves for those underperforming loans or for those properties that did have really kind of serious insurance issues, right? There's just one property that I can think of off the top of my head. There's this property that had, I think it was 8 down units due to a fire. And again, nobody underwrites to have a fire occur in year 3, for example. You don't expect your vacancy to drop. But what happened was vacancy dropped because those units were offline, and the operator was using a daily pricing system to gauge rents. And what happened was when the system saw 8 units vacant, essentially, it dropped rents across the board and really kind of shifted rents down across pretty much all the floor plans to really kind of drive that vacancy back up. But with us looking into it and getting a better understanding of what actually occurred, we actually saw tremendous value in that property and able to raise rents to where they were, because those offline units shouldn't be affecting the rest of the rental profile when they're offline for a specific reason. And then even more so when they come back online, there's more opportunity there, because now you have 8 pretty much fresh units that are fully renovated that are then hitting the market. The unfortunate part is that specific operator saw a pretty large jump in their insurance given the claim that they had to file. So, we're seeing insurance increases across the board, and that's why we also, build up a reserve ourselves for those unexpected items, especially for those older properties. As Robbie said, right, we're targeting newer properties, but those older properties where there are a little bit more skeletons in the closet and you have to do a bit more digging when you lift up the carpet, so to speak, you want to have extra reserves in place, especially for your repairs and maintenance budget as well.
Yes.
So, Robbie, can you talk to us a little bit about leverage and debt? I know you touched on it a little bit with, during COVID and with cheap debt especially, there's a lot of properties that were over leveraged. Can you explain why that might be more risky, and then how investors can look out for how to kind of essentially match their debt structure to that investment?
Yeah, absolutely. That's a great question. Because in some ways it makes sense. Like if you have low leverage, meaning the low cost of debt, like a low interest rate, you want to use as much of that money as possible and use and purchase properties based on a very high amount of that money, because it's cheap capital, right? So if you can leverage 80% of loan to value, why not take advantage of that? And many of us were back, a couple of years ago during this COVID craze in buying, where prices were escalating sky high. People were taking advantage of very high leverage debt, low interest rate, and that's why these deals made sense. Here's the problem. Once things correct, and once, like the market corrects, or there's a shift in whatever dynamic it may be, because you're so highly leveraged, you're going to have, if there's a drop in value of the property, say maybe 20%, your leverage is 100% of that particular property. If you used a high leverage loan at 80%, your leverage 100%. If you're looking to refinance that property, then you're going to have to put a lot of money into it to refinance, because no one's going to offer you a loan at 100% loan to value. Just obviously never happens. So you're in trouble when you're leveraging that high. In fact, whenever you are using high leverage, when you have these institutions or very savvy in family offices, they don't like to invest in those deals. They just, say, hey, look, I want a very low leveraged deal to invest in, because I know if there's something that happens to that, capital stack where, you maybe the value of the property drops, you kind of lose some of that, you're able to cover the debt service. And that's another important ratio to look at, is the debt service coverage ratio. And basically what that means is the cash that you're producing in that property, how many times does that cover debt service at any given particular month? So if you have, let's say the debt service is $100 and you're making $150 a month, then your debt service coverage ratio is 1.5. And banks really like that. That's a 1.5, or maybe 1.25 or 1.3 and above is something that the banks like, because they know that you have the cash that you need to cover the debt plus a little extra. And if that number starts getting closer to 1 or starts going below 1, that ratio, then that spells trouble, because that means that your property is barely able to cover debt service, or maybe not even at all. So that's the reason you really want to use lower leverage if possible, because it covers you in the event that things go south. If you do get a high leverage loan, because again, as I mentioned, sometimes it makes all the sense in the world to do so, make sure you're covering that with adequate cash reserves. So you have a lot of cash on hand, so that if something were to happen, you can use some of that cash and not have a capital call.
Because ultimately that DSCR that you talked about, Robbie, that's the lender's test for their kind of risk averse strategy of lending capital to the project too. And something to pay attention to when you're looking at a deal is the capital stack, right? Where is the capital coming from, and what's the cost of that capital across the board? Because typically, from a very generalized perspective, the capital that comes from debt, the actual financing, is the lowest cost capital. It's the one that costs the least, right? You might have, call it a 6% interest rate, and the cost of that capital is really 6%. Then you typically have, pref equity groups behind that, and then you have your investor base. But the one thing I want to note is that with pref equity and with your investors, you typically have a little bit more flexibility in the cost of that capital, right? So for some pref equity groups, for example, they might charge you 12% all in, but they might only charge you 8% current for that single year. So there's a 4% spread there, right? Same thing with investors. You might offer them a 7% pref, but most investors know, especially during the value add projects, that you might get 3, 4, 5% the first couple of years, and then get caught up on the latter, half of the project. So there is some sort of catch up with the capital that costs a little bit more, but there isn't as much flexibility when it comes to the debt providers and the debt lenders, even though their cost of capital is lower than the other two groups. And we're seeing it now. We're seeing a ton of deals that have gone into foreclosure almost, right? That are then sold back to the lenders, and now it's the lender's job to sell these properties, and that creates a lot more risk for them. So just keep that in mind. Where's the capital coming from to fund the deal? What's the cost of the capital? And then how flexible is each kind of group when you're dealing with them in terms of return of capital, as well as their cost of capital as well. So, Robbie, as we kind of wrap up and get to the tail end of the discussion, can you talk a little bit about fostering like a risk-aware organization within Viking, and then how you and Vic have really set up the structure to make data-driven decisions?
Yeah. So thanks, Nathan, for going over all this detail. And for those listeners out there, I hope you got a lot out of this podcast, because we're really trying to educate you and help you understand what you need to look at when you're looking at particular deals. And, our ultimate goal as a company, and the reason we started, was to help our friends and family invest like both Vic and I invested earlier on in life, and achieve some kind of financial freedom and independence. And our parents invest, our friends invest, our family invests, and we are extremely focused on making sure the investments that they make are good ones. So in order to do that, we obviously have to form this culture that is very data driven, that is very focused on risk and helping people understand the risk that they're getting into. And, ultimately, you are taking risk doing anything, right? You're taking a risk, buying any kind of consumer good. You're taking a risk when you put your money in savings because a low risk, but like banks shut down, or maybe the interest rate's so low it's lower than inflation. That's not good. But anything you do, you take a risk. So you want to make sure that the risk you're taking here it creates asymmetric risk reward, and that's in essence what we have done. We covered a lot of those details in this particular podcast, but there's so many more that we look at. We look at thousands of properties to really find the 4 or 5 that we choose to purchase every year, and we use all the data and metrics that we discussed. We have advisors, a team of advisors that we go to, and we constantly hit them up and ask them what is happening with the economy now, what's going to happen in the future, what do you predict? In your 40 years of investing, what have you seen? What will happen this coming cycle? And we can ask people that. We've created advisors surrounding us that can help us and guide us and point us to the right direction, so we can benefit, and you would also benefit as an investor in that process. So that's in essence, in sort of like kind of broad strokes, how we've created this culture, and what we're hoping for all of our investors, in that they do understand that there's a risk, but the reward on the other side is greater.
Yep. You and Vic do a great job of keeping a nice pulse check on the entire business and an organization too, right? We have quarterly goals with specific metrics that we're trying to hit, and we're always adjusting those and always keeping an eye on them, right? If you're, and same thing is true for your own portfolio, right? If you are only taking a look every 6 months or every year, you only have the option to pivot every 6 months or every year. But if you're looking at properties on a weekly basis, company goals on a monthly and a quarterly basis, you have more optionality and a quicker time to pick up when things don't go as planned, right? And so we do that at the Viking level, but also on the property level as well. So, Robbie, I think we dove into a great discussion today on risk and returns, asset classes, asset management, what investors should look out for. Any last bits of wisdom for the audience?
Yeah, I would say, really leverage the expertise of Viking, of maybe other sponsors that like and trust, but don't jump in without fully understanding something. Like get other people that have been there, that have done that, to help guide you to getting where you want to go. So I would just say my last thought, and something that I think would be very helpful, is to just ask others that are in the know, that have the experience, what they would recommend that you do, because that could be very helpful, especially if you're in a particular situation that you want to discuss that may be different than others. We can really get nuanced in helping folks out. So that would be my last thought.
Yep. And absolutely, part of creating that risk asymmetric return profile is educating yourself. So hopefully you guys got a few bits of really solid knowledge and actionable items out of this podcast. So you've actually already done yourself a service by gotten one step closer to having a risk adjusted profile. So more power to you, and we'll catch you on the next episode. Thanks, everybody.
Thanks, Nathan.